What's up, everybody? This is Jack from Clover Trading, and today I'm going to talk about my own journey with finding consistent profitability. And I'm also going to talk about consistent profitability as a whole, go over a couple details of it, what it is, what it isn't, and hopefully you can learn something from it and it'll help you in finding your own consistent profitability in trading. Consistency is one of the biggest things that traders need. And if I share anything in this information, good information, if you like it, if you find it useful, entertaining, make sure to like and subscribe, share the video with a friend, share with a family member. All right, now what is consistent profitability? What I think it is a risk reward that you're able to apply to a certain setup or scenario in the stock market that over time it will pay out. It doesn't mean that you are consistently profitable. Now any trade you make, it's going to make money. It's just not how it works. There's no learning or studying that you can possibly do to factor out any possibility of a loss. It just will never happen. There will always be losses in the stock market. If you come to the stock market, you have to be prepared to lose. So let's do an example. You can have one win, one loss. Now, right there, that is a 50% probability of winning. On the win, you make $1 or $100, make it more exciting. On the loss, you lose $25. That together makes a net profit of $75. And it's not always that apparent in trading because oftentimes people will go to like different tickers, they'll have a more randomized profit factor, they'll have more randomized profits. Furthermore, if you have a 50% win rate, that doesn't mean that you win one, lose one, win one, lose one. You could lose 5, win 1, lose another one, and then win 5. And that would technically be a 50% rate. Or you can lose 100, then win 100, or lose 50, then win 50. Or you can win 50, then lose 50, whichever way you want to cut it. But either way, that is going to create a 50% win rate. But if you do not manage risk in a way that can account for a long string of consecutive losses, then you just will not be profitable. It doesn't matter if you have a profitable setup, you will not have profitability from it because you didn't manage the risk to survive all the consecutive losses. Even if you have a consistent profitability, managing risk is still the #1 priority in trading. Another point that I want to touch up on is consistent profitability. It means you know what to look for, you know what to trade, but more importantly, you know what to avoid. In the stock market, there are over 20,000 tickers, and all these things are moving, and oftentimes social media will see people post all these crazy gains, and it'll get in our head saying like, oh wow, I should have played this ticker, I should have played that ticker. But if that's not your setup, there's no need to even trade it. It's like going to away territory to play a game. It's much more complicated. You always want home turf, and if you have your own setup, that is your home turf to play on, and you stick to that because that is one beauty of the stock market. We are able to pick and choose what we play, where we play it, when we play it. We can control all three of those things, and all three of those things we must control. And then on top of that, we have to manage the risk with it, knowing when not to play it and when to get out. So in my own journey, I traded for 3 years where I just really didn't have much success. I would still win at times. It would be like a hot sector, or maybe the stock market was just heating up and I could trade perfectly and I would make a bunch of money. But once the market shifted and it began to slow down, I would slowly just dwindle away all those gains. And that always felt bad, but it was a factor of 1, not adapting, but 2, keeping my risk the same or not sizing down the risk when I was not being profitable. And 3, trying to go into other things that I didn't understand. So maybe I was trading multi-day breakouts all the time, and then I would suddenly try to dip buy stuff. And if I'm doing that, I don't have data or I don't have experience with that setup. So why would I touch it? Because you're putting all these factors against you. You should always back test these things before you go into it openly. On top of that, how did I find the consistent profitability? So it all started when I began finding this setup that would appear in the stock market. It would appear like 2 to 3 times per week. So right off the bat, I had a really high frequency of this setup, and I could try out trading on it again and again and again, and I could perfect that trading, and I already had back testing for it, so I could find a point of risk and I would have price targets. And then I knew that the further away the price target was, the less probability of it hitting. So if it was a further away price target, or it seemed further away compared to like how it was trading, maybe it was consolidating weirdly or something like that, I would just begin to take some off. I would be more proactive with it, and I would take profits. There's no need to be greedy because I could just leave a little bit on and still let the trade ride for me. And then if it did get to my price target, great. If it went back and squeezed, or it saw me out, cut it. The worst feeling would be that if I left the trade on and I just got too greedy with it, maybe it hit my price target or maybe I wanted more, but then it came back and it stopped me out, then I would have lost 100% of the unrealized gains just breaking the rule. And that's not consistent profitability. Consistent profitability comes from just consistently executing the same thing over and over again. It's going to be boring, but that's how it's done. It has to be boring because people don't want to do boring. They want exciting stuff. They want to chase the new hot stock of the day and they want to go after it and make a bunch of money. But it's just unrealistic. So consistent profitability, it comes from having risk rewards that can play out for you over a series of time. And just because somebody has maybe a 90% win rate, it doesn't mean that they're even profitable, because on the one time maybe they lose over 100% and then they lost the whole account. Or maybe they only have a 10% win rate, but on the 10% that they win, they're winning so massively that it covers all the losses. So it's sort of this balance beam in consistent profitability, that the probability and the payout, and those two come together, and that's what gives you a positive expected value in trading. And we have to abuse that as traders. We can't let certain things like FOMO or over trading or any sort of bias like that get in the way of, because as soon as we do that, then we can take losses that are unnecessary. That is how you really lose your consistency. So once again, being consistently profitable does not remove the possibility of a loss. Rather, you will still have losses, but you're in a position where you can have profitable trades that pay for the losses. And on top of that, we are taking trades that we can trade over and over and over again. Having one big home run is cool, but if you can't mimic those results, then it's not a consistently profitable setup. And not saying it should be avoided, but it should be taken with more care, and it should be understood that this isn't something that you can live off of. Consistently profitable trades where you have a repeated frequency of a setup, that is something that you can live off. You can keep trading it week after week, month after month, year after year. So once again, my name is Jack. I'm from Clover Trading. If you like the content, found any of this information useful, like and subscribe, comment down below what your favorite point is, or maybe something about your own consistency or something that you've learned along the way in trading. All right, see you next time. Stay tuned. Every week we upload videos. Have a good one.